Welcome to Analyst's Estimate. We bridge the gap between Wall Street and Main Street by breaking down complex investment research so you don't have to. Disclaimer. This podcast is for educational analysis, not financial advice. AI powers much of our research, but AI can make mistakes and data can occasionally be inaccurate. Treat this as a business analysis rather than deep company research. Always do your own due diligence before investing. Today, we're doing a deep dive into an equity research report on a company called Azad Engineering Limited. Now, this might be a new name for some of you, but they are a really critical supplier for some of the biggest names in aerospace, defense, and energy.
That's right. And it's a story of really explosive growth. What we have here is a very comprehensive report, and our job today is to really dissect it.
Go beyond the summary.
Exactly. We'll look at the financials, of course, but also their competitive moat, what makes them special. And importantly, we have to spend some real time on the risks. There are some, let's say, serious forensic red flags here.
Okay, so the mission for you, our listener, is to understand this trade-off. The market is clearly optimistic, but it's demanding what the report calls a price for perfection.
And our job is to find the data that either supports or questions that price. Let's get into it, starting with the big picture.
The executive summary.
Right. So Azad's journey is, frankly, pretty remarkable. This wasn't some huge conglomerate. They started as a small CNC workshop.
And now?
Now they're a Tier 1 supplier to companies like GE, Rolls-Royce, Mitsubishi. That leap is all about their absolute obsession with zero-defect precision engineering. In aerospace, you don't get a second chance.
And that technical skill, I assume, translates into some pretty impressive numbers. What are the FY25 results looking like?
They are. Consolidated revenue for FY25 was INR 4,573.54 million.
Yeah.
But that's not the headline number.
What is?
The profitability. They hit an EBITDA margin of 35.6%.
35.6. Wow. For a manufacturing business, that's phenomenal.
Yeah. It's industry leading. It tells you they have incredible pricing power, or they're just incredibly efficient in a very high-value niche. Probably a bit of both.
And what about top-line growth?
And this is where it gets even more interesting. Between fiscal 21 and 25, they had a revenue CAGR compound annual growth rate of 39.1%.
Almost 40%. So this isn't just steady growth, it's a real acceleration.
It is. And that brings us to the balance sheet. There was a major event here, the QIP.
The qualified institutional placement, a huge capital injection, right?
A huge one. INR 7,000 million in February 2025. It completely changed their financial structure. They're now a net cash company.
So they've built a war chest.
That's exactly what the analyst calls it, a fortress structure. And all that cash is earmarked for their CapEx plan, which is, well, it's incredibly ambitious. They're targeting a 10x capacity expansion.
A tenfold expansion. That is a massive bet on future growth. And it brings us right back to that price for perfection idea. We're talking about a stock trading at, 95 to 99 times PE?
We are. And when you see peers in the 35 to 50x range, you really have to ask why.
So what's the justification?
Revenue visibility. The order book is INR 6,080 million. That gives them visibility of over 12 times their current revenue.
So in a sense, a lot of that future growth is already contracted.
It is. And the market loves that kind of certainty. But, and this is a big but, a high valuation always amplifies the risks.
Let's talk about those. The report lays out 4 principal ones. What's first?
Customer concentration. It's pretty straightforward. About 60% of their revenue comes from just 3 big OEMs.
So one of them sneezes.
Exactly. Even a slowdown from one of them could really hit the short-term numbers. The second risk is CapEx execution.
Linked to that 10x plan.
Directly. A plan that big and complex is just fraught with risk. You have potential delays, cost overruns, problems getting new lines stabilized. The market is expecting that new capacity to come online smoothly in FY26 if it doesn't.
That 99x PE multiple is not going to hold up. What's risk number 3?
It's a financial one. The working capital lockup. They have a 287-day working capital cycle.
Okay, break that down. What does that mean for them day to day?
It means from the moment they buy the raw metal to the moment they get paid for the finished part, almost 287 days pass. When you're doing this fast, that cycle just sucks up cash.
Even with the big QIP, that's got to be a strain.
A huge strain. And finally, the fourth risk area is what the report calls forensic gaps.
The governance issues.
Yes. We'll get into the specifics, but we're talking about legacy accounting issues, high related party transactions, and some transparency gaps in their audit trails. These are things that make institutional investors very nervous.
Okay, so a lot of risk. But for the market to support this valuation, the opportunity must be huge. Let's zoom out to the industry.
It is huge. We're looking at major secular trends. The report projects two key total addressable markets, or TAMs, out to 2027.
What are they?
First, the aerospace and defense components TAM. That's projected to hit INR 153,000 crore, growing at about 9% a year.
And what's driving that?
Mainly, the massive recovery in commercial air travel. Revenue passenger kilometers are expected to basically double by 2029. More planes flying means more parts needed.
And the second TAM?
Energy turbines. That's projected to reach INR 181,000 crore, growing at a 7% CAGR. This is being pushed by things like nuclear power restarts and the shift to new hydrogen-ready gas turbines.
So the pie they're chasing is massive, and it's growing. That brings us to their competitive moat. How do they defend their piece of that pie?
This is really the core of the bull case. The report uses Porter's 5 forces to break it down. Let's start with the threat of new entrants.
How high is that threat?
It's rated a 1 out of 10. The report calls the barrier almost impenetrable.
Why so high?
It's that vendor qualification cycle. It takes 30 to 48 months for a new supplier to get approved by a GE or a Rolls-Royce. And that's if you can meet the technical specs.
The 0 parts per million defect mandate.
Exactly. When a turbine blade fails, it's catastrophic. So the OEMs are incredibly reluctant to switch suppliers once they have one that works. It just locks in players like Azad.
Okay, so it's hard to get in. And what about their power relative to their own suppliers and customers?
Well, supplier power is high, rated an 8. They depend on a small number of approved global producers for their exotic superalloys, things like titanium and pneumonic. So they don't have a lot of leverage on material costs.
And on the other side, firepower.
Also high, a 7, because their customer base is so concentrated. But, and this is key, it's mitigated by those incredibly high switching costs. You can't just swap out a supplier for a complex 3D airfoil that's designed to spin at 1400 degrees Celsius.
That technical lock-in really is the moat. The report also mentions something called the execution moat. What's that?
That's the idea that the moat isn't just the machines, it's the institutional knowledge. They manage over 1,700 different qualified parts. The real advantage is the process engineering, knowing exactly how to work with these exotic metals without weakening them.
And they use that knowledge to control costs, right? The report mentioned an interesting strategy.
Material indigenization. It's a brilliant move. Instead of importing all their superalloys, they're actively qualifying Indian bells, like Sunflag and Starwire, to produce them locally.
What's the impact of that?
It's huge. It secures their supply chain, but it has also directly improved their gross margins by 3.4%. That's a massive operational win.
And what about labor costs, especially as they scale?
They're leveraging automation, robotic polishing, 5-axis milling. Salaries are only about 20% of their total costs. By automating, they can increase volume massively without a proportional increase in headcount, which drives down the per-unit labor cost.
Let's shift to the historical financials, but I want to focus on cash. We know the growth is there, but what about the quality of that growth?
A great question. So we saw that consistent 30 to 40% revenue growth and the EBITDA margin jumping from around 24% to over 35%. But if you look at return on capital employed, ROCE, it tells a slightly different story.
How so?
It peaked at 26.2% in FY24, but then it actually compressed to 20.7% in FY25.
Which an investor might see as a red flag. What's the reason?
It's a timing mismatch. The QIP cash landed on the balance sheet, which instantly increased the capital employed denominator. But the revenue from the assets bought with that cash hasn't come online yet. So the compression is an accounting effect, not an efficiency problem.
That makes sense. But were the profits actually turning into cash from operations?
Yes, this is a good sign. Operating cash flow, or CFO, swung from a small negative in FY24 to a positive INR 629 million in FY25. So reported profits are becoming real cash.
Okay, but that's not the whole story. What about free cash flow?
And this is the critical point. Despite the positive operating cash flow, free cash flow is still deeply negative.
Because of all the CapEx.
Exactly. Let me give you the numbers, because they're important. FY23 FCF was negative 940 million. FY24, negative 781 million. And in FY25, as they started deploying that QIP money, it dropped to negative 2,354 million.
They are burning through cash to fund that 10x expansion.
They are. It's a classic growth story, sacrificing all near-term cash generation to build the foundation for a much larger future business.
Okay, which makes governance and trust in management absolutely paramount. Let's tackle those forensic gaps. The assessment score was 65.25 out of 100, which sounds worrying.
It is. We have to talk about the RPT red flag. In FY24, the company sold some subsidiaries to the promoter. That transaction generated a gain of INR 56 million.
Okay, And how significant was that?
It propped up 54% of that year's entire net profit.
Wow. Over half the profit from an internal transaction.
Exactly. It raises serious questions about earnings quality. Are they relying on operational growth or on these kinds of transactions to hit their numbers? It's a huge transparency issue.
What was the other major flag? Something about their SAP system.
The audit trail issue. The auditors themselves noted that the audit trails in their SAP system weren't enabled at the database level.
In simple terms.
It means it's difficult to see who changed what data and when. For a company this complex, that's a major gap in internal controls.
And on top of all that, the promoter sold a chunk of his stake.
Correct. A 7.4% stake reduction in June 2025. The market saw that, and the stock corrected 11% temporarily.
Yeah.
It just shows how sensitive the stock is to any perception of insiders losing faith.
Okay, so we've got a fantastic growth story with a deep moat on one side, and on the other, significant execution risk and some pretty serious governance questions. How does this stack up in the valuation against peers?
This is where the picture gets clear. Let's look at the FY24 data. Azad had a PE of 91.6x, but that was backed by a 34.2% EBITDA margin and that huge 12.5x order book visibility.
And how does that compare to, say, MTAR Tech?
MTAR's PE was way higher at 1 of 55x, but their fundamentals were weaker. Their EBITDA margin was only about 18%, and their order book visibility was half of Azad's at around 6x.
So the takeaway is that while Azad's valuation is high in absolute terms, it's actually more justified by its superior operational performance and visibility compared to its peers.
That's the analyst's conclusion, yes. The premium is for a reason.
So looking ahead, what are the key things we need to watch to see if this story plays out? The report lists 4 monitorables.
Number 1 is the H2 FY26 inflection. That's when the new facilities for GE and Siemens are supposed to really start ramping up revenue. We need to see that happen.
What's next?
2, a product mix shift. They need to move from just selling components to selling entire subassemblies, especially for defense projects. That captures much more value. 3 is nuclear momentum. That big Arabelle contract needs to be a gateway to more global nuclear work.
And the last one?
Working capital correction. They have to prove that their indigenization plan can bring that 287-day cycle down, starting around Q4 of FY26.
And even if all that goes right, there is still 2 big macro risks hanging over them.
Always. First, geopolitical dependency. 92% of their revenue is from exports. A trade war or global instability is a constant threat. And second, that concentration risk. The loss of a single major program like Mitsubishi Phase 2 would immediately wipe out about 21% of the revenue.
So synthesizing all of this, what's the final verdict?
The final verdict is that Azad is a unique, high-quality, structural play on the India for the world manufacturing story. It's got a durable technical moat that is very, very real.
But the valuation is steep, so what's the actionable insight for you, the investor, listening to this?
The analyst feels the current price is too high. They recommend waiting for some market volatility. Look for an entry point in the INR 3,350 to 1,450 range. That brings the PE down to a more palatable 75x to 85x range and gives you a bit of a margin of safety.
A margin of safety for those execution and forensic risks we talked about.
Exactly. So you're buying into a fantastic story, but at a price that acknowledges the challenges. But that brings me to one final thought for you to chew on.
All right.
Given their heavy reliance on those imported superalloys and the sheer massive scale of this CapEx plan, what does that deeply negative free cash flow trajectory really tell us about their funding strategy after this initial QIP cash is all spent? That's the billion-dollar question that management will have to answer over the next few years.
Thanks for tuning in. Remember, this isn't financial advice, and since we utilize AI, always verify the data yourself. See you next time. Welcome to Analyst's Estimate. We bridge the gap between Wall Street